Oliver, call me crazy, but I quite like stress tests to be a lot worse than the reality. And so when the EBA, European Banking Authority, released its stress test plan for this year today, I noted that it expects stock markets across Europe to fall by a fifth over 3 years, and yet GDP over that period to fall by 7%. So my first question is, does that look severe enough?
Well, it looks pretty severe, a 7% contraction in GDP from the baseline scenario, and this is the eurozone baseline, is a pretty severe recession, and that would imply house prices down about 20%, commercial property prices down about 15%, so pretty tough. But as you say, the fall in equity values doesn't really seem to reflect that. Equity markets down a fifth, while during the 2008 crisis they almost halved, so it could have been a lot tougher. But this really reflects the EBA's need to keep a balance here. It needs to be tough enough to be credible. The last round of European stress tests weren't credible at all. Several of the banks that passed went on to blow up shortly afterwards. But on the other hand, it can't be so tough that the banks turn around and say, well, actually, in response to this, we're going to choke off credit and stop lending.
Yeah, I remember such stars as Bankia and SNS Real passing those tests.
Indeed.
But the next question then is, well, how many banks have raised capital over the last year in advance of these tests?
There's been a fair amount. I mean, banks that thought they might have a problem with these stress tests and the asset quality review, which is taking place in the eurozone at the same time, a lot of them have been raising money. The EBA says about 25 billion euros has been raised since last September, and there's been a lot of the peripheral names, Raiffeisen in Austria, which has its operations in Central and Eastern Europe. Some of the Greek banks have all been tapping the equity markets for money, getting ready for this, so that when push comes to shove in the stress test this year, they get a pass rather than a fail, or rather than a demand for a big new capital increase.
Okay, those are peripheral banks, but I think one elephant in the room here is Deutsche Bank, because lots of people say it hasn't raised enough capital. What do we think?
Well, certainly it's not the healthiest as far as capital of the EU's banks. Its core tier 1 ratio is well below the average for other large sort of universal banks in Europe, and it declined in the past quarter. It had various difficulties, particularly in its fixed income trading business. So its capital ratio isn't great. Now, it has raised a bit of alternative tier 1 capital yesterday. It said it raised 1.5 billion euros, but this isn't real core capital that we like to see. Everyone's expecting a big equity raising at some point from Deutsche, but it's not come just yet.
Okay, well, more stress to come. Thank you, Oliver.